Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe the channel. Analysis: some US firms wait to issue bonds in a bad rates will come down. Some US companies with the best credit ratings are looking at shorter-term debt solutions as a bridge to better funding environment in a year or two, slowing new bond issuance despite demand from investors. The shorter-term debt solution include getting bank term loans, drawing down on bridge loans, and issuing bonds with maturities of 5 years or less. Debt capital market bankers and credit investors said while loans can be cheaper than issuing bonds, shorter-term debt is currently more expensive than longer tenors. With the move, these companies are effectively betting that aggressive interest rate increases by central banks that have raised funding costs will cause recessionary headwinds which would eventually lead to lower treasury yields. So instead of looking themselves into longer-term debt with higher all-in funding costs now, they plan to wait out the surge in interest rates. We have seen evidence of issuers relying on shorter-term debt solution as an alternative to long-date bond financing in an effort to bridge to better funding environment in the future, said Maureen O'Connor, global head of high-grade debt syndicates at Wells Fargo. It is hard to argue against the rationale. The trend, which is coming into focus now, shows how companies are navigating an unprecedented monetary policy tightening and uncertainty in global markets. Some bankers said the approach could be a risky one. The US Federal Reserve has not only been raising interest rates quickly but also warning markets that it would hold them high for longer. Companies looking to wait for more sustained stability may have to be patient for a long time, said Megan Graper, Global CEO head of investment grade syndicates of Barclays. Standing down, even so, the supply of new high-grade bonds has shrunk, with September issuance volume so far on track to make it the lowest for the month in a decade, according to data provider Informa Global Markets that has hit the supply of good quality assets just when investors need more safe places to hide. It will also eat into fees for Wall Street banks. Natalie Tepitic, head of investment grade credit at Payden and Regal, a fund manager, said investors were looking for higher quality issuers, even as a number of issuers have been standing down from the markets. What we have seen is a shift to shorter dates financing, Traffic Hicks said. Earlier this year, Oracle Corp, for example, was widely expected by bankers, analysts, and strategists to issue $20 billion worth of bonds to fund its acquisition of healthcare IT firm Corner Corp. The $28.2 billion deal closed in June. Typically, companies take a bridge loan to fund mergers but then pay it down with a long-dated bond issues before closing. Oracle instead drew down $15.7 billion from a one-year bridge loan and took out term loans worth $4.4 billion with 3-year and 5-year maturities that could be prepared early to refinance the bridge loan. The tech giant also doubled the size of its commercial paper program to $6 billion and said that it could expand to the size of the term loan to $6 billion. More recently, Adobe Inc. said it will fund its $20 billion acquisition of cloud-based designer platform Figma with stock and cash on hand, throwing in a term loan if necessary. Reuters could not determine Oracle's Adobe's rationale behind their funding decision, but bankers said their actions were evidence of the broader trend. An Adobe spokesperson said the company was able to finance the deal given its cash flow if a term loan is necessary due to timing of the deal closing. We expect to pay it back quickly, the company said. Oracle did not respond to requests for comments. Bond syndicates had estimated based on their visibility of the issues pipeline that September would see as much as $150 billion of new bond supply. Okay, that's all for me. Thank you for watching. Don't forget to like, share, comment, and subscribe. Thank you.